With some money being made, people tend to become a little overconfident, move into say futures and options, try to leverage so that they can make quick money. You not only have to be right, but you have to be right in a particular time span. So you make time your enemy actually. Then when the correction comes, most of the time people are caught off guard and they suffer during corrections. The second edge one can have over the crowd is a quantitative edge.
So people who are making calculations for their retirement planning for long term, what's a fair return to expect from, I'll say, 15 years, 20 years of investing so that they make the right calculations? Hello, welcome to the next edition of This or That. Today we are very excited to have Nimesh Chandan with us. He is Chief Investment Officer with Bajaj Finserv AMC. He has over 25 years of experience in capital market and mutual funds. He was previously associated with Canara Robeco Mutual Funds, heading their equity division. He was also fund manager with iPru and SBI Mutual Funds. So we welcome Nimesh. Hi, thank you very much for your time.
Thank you, Bhartendra. Pleasure to be here.
So, Nimesh, we'll try to keep it simple, not technical, and I want to ask you some basic questions, and we'll keep it not at a level of a fund manager, something that audience can relate to. What do you think has, in your long experience, changed in last 10, 15 years in terms of investing? You know, how people have changed in terms of their behavior.
So if you look at history of investing and you look at different asset classes, different bubbles and busts, events may be distinct, but behavior patterns are similar in all these booms and busts. So not much changes in terms of investor behavior. Yes, businesses change, securities change, economies evolve, asset classes, there are some new asset classes that people look to invest in, those come in. But nothing much changes in terms of human behavior. One of the things, though, in the current, say, scenario or in the recent 5 years or so has happened is, there is a lot of information blast that is there on you, right? We are being bombarded with news, information, analysis, whether it's on social media, whether it's on news channels, on our phones. So the noise levels have gone up. Information has become more efficient, so people are able to get the right information, right data points quickly. And because of some models, they are able to process it efficiently also. But the level of noise has gone up a lot, and sometimes that impacts investment decisions.
So people are investing in the same manner, or do people nowadays start early? Do you have any such data saying people have started investing early or favoring certain set of asset classes?
So that consciousness has come in, that they need to be conscious and diversify their investments, start early. I think this generation is more aware about their options, more confident about their future, and hence their investment patterns or their choices have also evolved in that. And many are starting early. But yet, I would say, still some awareness to be created for people that it's not only just saving, but it's also investing early creates wealth for you and gives you a very secure future.
So have people started doing that, or let me ask you this way, that so much of experience in investing, do you see the same mistakes getting repeated over the time, or things have changed, or are there any things you say, oh, not again, something like that you have observed?
So behavioral patterns, as I said, the investing patterns remain the same. In bull markets, people get attracted into equities. They open accounts, they refresh their portfolio very often during the day. Even if they are long-term investors, they keep track of what's happening on a daily basis or sometimes on an hourly basis. With some money being made, people tend to become a little overconfident, move into, say, futures and options, try to leverage so that they can make quick money. Then, when the correction comes, most of the time people are caught off guard and they suffer during corrections. They get disappointed. Um, at first, there is loss aversion. They don't want to book losses because it pains. They start averaging. But at some point of time, the fear reaches its peak. People panic and they sell. And then they don't want to refresh the portfolio. So I think these patterns, they remain the same. There are three ways one can do better in investing in terms of having an edge of investing. You can have an information edge where you have superior information or better information than the others. But that, as I said, because of bombardment of data these days and information, very difficult to stay ahead of the crowd all the time in getting the right information. The second edge one can have over the crowd is a quantitative edge, where if everybody has the same information, you process that information better than the others. Some extent, work has been done on financial modeling and analytical modeling, but still a lot needs to be done. The third edge is the behavioral edge, that suppose everybody has the same information, suppose everybody copied each other's models of processing that information, still people react very differently to the outcome or the output of those models. This is the behavioral edge. And whenever money is involved, a lot of emotions and biases come into play. And people react to different information at different points of time differently. So if you see a chart of a falling stock price, some people will look at it as an opportunity. Some others will start looking at it out of fear that this is there's something going wrong. So over the years, what I've seen is one big change, that the behavioral edge is becoming more important if you want to generate alpha, if you want to do better than the crowd in investing. And a lot of effort from Bajaj Finserv AMC has been to make people aware of these biases that can hinder your investment journey. And
Could you talk about some of these biases?
So there are many. I have studied like 80 of them, and some 40
Maybe
are
you
important.
could- okay.
I'll talk to you about 3 or 4 which are more common. Otherwise, we'll keep continuing this. Let's say confirmation bias. That's the most common bias that we come across. Confirmation bias means once we take a decision to invest in something, we start looking for confirmation of that. So we start looking at only those data points that agree with us, that I made the right decision. We like to meet people and talk to people who reinforce this the idea that we are going with. So if somebody has a negative or somebody highlights the risk about my investments, I may try to rationalize, this time is different, this doesn't work. And whoever says something good, oh wow, this is a very good company or a good business or a good investment, I like to talk to them. So that's confirmation bias and happens to everybody.
So, if I understand this correctly, does this mean, say, for example, I like one particular stock, no matter what anyone says, I am thinking that this is the correct stock and I will ignore all the information. Is this correct way to understand this?
So 2 things here. See, one, you not ignore what others are saying, but you choose to listen to those who agree with you. And you try to rationalize those comments that are not in agreement with you. So if somebody shows a risk, okay, you bought this, but there's a risk there. And you try to rationalize, no, this is not a risk. Or maybe it's too trivial, or it won't happen. Something like that. What confirmation bias does is it kind of makes you ignore the risk. And you're not prepared for it then. And investment is about not only forecasting and getting your idea is right, but also understanding the risk that the future may not unfold exactly as you expected. So you need to provide for that. So you need to provide for the risk in terms of either the valuation that you're paying, the price you're paying for it, or you need to keep a stop loss or a pre-commitment that this is my investment case, and if it doesn't happen, I need to get out.
Mm-hmm.
So confirmation bias is very common. Second important bias is loss aversion.
Mm-hmm.
Uh, Psychologists have said that you feel twice the amount of pain if you have a loss of 100 rupees than the happiness you would feel if you have a profit of 100 rupees. So loss is painful. So people try to avoid taking a loss, or sometimes it works as a myopic loss aversion, that even if you know that some investment is good, it's going from 100 to 200 after some time, you are worried that it will go to 95 next month, and so I don't want to touch it. And third important bias that comes in is overconfidence.
Mm-hmm.
When you have a series of wins, or you're on a winning streak for some time, people generally become overconfident. Again, they ignore looking at risk. In its worst form, overconfidence makes you leverage. And as you know, in futures and options or any leverage that you take, uh, you not only have to be right, but you have to be right in a particular time span. So you make time your enemy, actually, right? And that hurts investment returns. So these are the common.
So you said knowledge, quantitative edge, and behavior edge. So if I stick to mutual fund investors, uh, uh, they are expecting knowledge and quantitative edge to be taken care by the fund manager. They have to only take care of their behavior. So what would you suggest to a mutual fund investor that they should be doing? You know, because let's say I don't know equity, I don't want to do all of that. That's why I've come to a mutual fund. So what will you tell as a fund manager to the investor that this is what you should be doing? I am taking care of the knowledge part.
So clearly, when one is investing, either you put your own time and effort in analyzing the investments yourself, and you take your own judgments. It's not easy.
Mm-hmm.
It requires a lot of commitment. A lot of investors don't, because they are either having their own business or working somewhere. They may not have that time. They may be professionals who are busy in their day-to-day schedule. They can rely on a mutual fund, which is actually a team of experts who is doing that work for you, who's doing the research, who's forecasting businesses, economies, studying the right valuations to be paid for each business, creating a portfolio that balances in a way, what returns we are making versus what risk we are taking, and keeps updating and changing in case it is warranted. So a mutual fund gives you expert knowledge and management in your investment journey. If one important thing required for investors is to have a long-term horizon. Now, a lot of people enter investing with a long-term horizon. But whenever money is involved, as I said, a lot of emotions come in. And which is why people somewhere in the middle may lose track of why they actually started this investment journey. They, instead of looking at long-term returns and long-term goals, they start reacting to short-term issues or short-term news. So if one is patient and one has a long-term investment horizon, a lot of biases get taken care of. And suddenly, volatility, which scares investors in the short term, becomes an opportunity if you are a long-term investor.
So what is long term? How long?
Depends on person to person, but every asset class has a certain volatility and returns in the short term and the long term. So typically, when we are looking at equities, for example, we tell investors that you have 3 to 5 years kind of a investment horizon minimum. If you're looking for shorter period than that, either you go for a fixed income or a hybrid kind of investment because they are less volatile. And if your goal is in the near term to get a certain amount of money, it is better you take a less volatile investment so that you know that the journey will be secure in the shorter term. The longer you look, then equity investments over the Indian markets have given long-term good returns. And though they are volatile, if you have an investment horizon of say 10 years, 15 years, 20 years, your chance of having a bad experience really goes down to negligible. So there are many studies, even we have done studies which show that if you're doing lump sum investment, if you're doing SIP investments, if you have a 10-year investment horizon, your chance of making a loss is extremely low, negligible. And in fact, in one of the studies, we saw that in the Indian markets history, if you have a 10-year investment horizon, it is very good. The chances of loss are very minimal. And in case you get caught on a bad year on the 10th year that you are investing, you just have to wait for 2 years, and then it's just a small fraction that you would lose money in the equity market. So again, as you stretch the horizon a little longer, investment horizon, say 10 years or so, your chance of having a bad experience in equities reduces. The nearer you are in terms of your goals, you should look for fixed income investments or at a medium term hybrid kind of a investment.
So, long term is a good advice, but it could be scary, right? So, people have limited money, they're putting their money for such a long period. What can you tell them as a expert in the capital markets for them to be convinced that it's okay, some data, some number, some insight, that yes, they can trust this long term advice and stay put?
So SIPs are a discipline that can help any investor. You get the benefit of averaging. So in fact, if you see volatile markets, that what you've seen in the last month or two, SIPs take advantage of that volatility. So you get more units if the market corrects, you get less if the market is moving up. So you are invested in a compounding asset, but you are also averaging your cost accordingly. SIPs work because they are automatic. You are making a commitment that every month you will put this money automatically. And if they were not automatic, even SIPs won't work. Now, I give this example to people that think about it, that instead of an automatic SIP, every month the bank manager calls you up and says, sir, you have to put 10,000 or 5,000 rupees in this fund on this day. Should I go ahead? Now, if every month you get such a call, your investment decision will keep changing based on the mood that day or market mood that day. You may decide to change the fund. You may decide to change the allocation. You may decide to altogether skip the SIP or no. This systematic way of investing gives you discipline. And in the long run, this discipline gives you returns.
So people who are making calculations for their retirement planning for long term, what's a fair return to expect from, I'll say, 15 years, 20 years of investing, so that they make the right calculations?
So I would say the returns vary depending on where you are entering in a way. If you see from the 1978, the inception of the BSE Sensex, we are going at about close to 16% compounded kind of returns in the headline index. If you are invested in a small cap or mid cap or any sector fund or thematic fund, the returns may vary. I would say that equities over a longer term, if you are a 15-20 year investor, will give you better returns than fixed income, what rates we are seeing currently. Difficult to put an exact number, but whenever investors are forecasting, uh, taking a conservative number on each asset class and then designing your asset allocation is better. And at some point of time, you have to have certain reviews of that asset allocation, change if any change is warranted. Many a times in a bull market, equities you've invested well, it becomes a very large part of your portfolio. At that time, it may be prudent to take some money and realign to your asset allocation into an asset which gives you more opportunities. Say, for example, some people may invest in commodities or gold or fixed income. So this rebalancing has to be done on a regular basis, not at a short-term basis, but on a regular basis. One should do that.
Something very interesting I came across basis what you were just saying. Very senior fund manager commented that people sell their winners and keep their losers. Okay, and when we talk to our clients, they say that when we ask them where is your money, they say we booked the profit. So what ends up happening is they've sold all the good stocks and they keep their bad stocks. So what is your if somebody wants to actually rebalance and have a good portfolio, what is your advice? How should a person look at rebalancing their portfolio to ensure that they have good stuff, and what are the funds they should exit, what they should keep?
Interesting. This is actually called disposition effect, where it is easy to book profits, very difficult to book losses, and people stick on to their losers and keep the winners, take profit on the winners.
Yeah.
This happens because of, again, certain emotions and biases that we hold. Most of the time, the losses are kept because of hope. And if you are keeping something because of hope, you are actually doing the wrong thing. Hope is different from expectations, optimism, and desire. Expectations are different because suppose your home team is playing a game in cricket against some other team. Looking at the team's lineup, you may expect the opponents to win, but you still hope that your home team wins. So that is different from expectations. Hope is dangerous because it means you entered the investment with a certain investment argument, but in some time that because of some reason that investment argument doesn't exist anymore. The reason you entered because of changes in business or management or something went wrong and it doesn't exist. But you're not acknowledging that has changed and change your position. You keep holding on to it on hope. You are anticipating a positive surprise that will help you get out at break even or something. So that impacts your decision making. This happens when we are looking at a certain particular, say, asset class or a particular investment within that, a particular security within that. Asset allocation looks at it slightly differently. Asset allocation is not saying book profits the moment something goes up and hold on to your losses. What asset allocation does is it says that now something has done so well for you and it has become such a large part of your portfolio that for risk management, you need to change. What you change to is also not because of that asset is making losses. So you have to add more there. That asset, when it becomes undervalued and provides opportunity, you allocate to that. So I would say asset allocation is a risk management tool which helps smoothen your journey towards your goals. Hope is very specific investment argument going bad, or disposition effect is because of a specific investment argument going bad and you reacting to that.
So, what should investor do about it? Like, so they enter with the hope only, right? That I'm doing this investment, this is going to give me good returns. So how should they look at it? Because other than the performance, what are the things they should look at a mutual fund? Because it has been advised that don't look at the past performance. Fair, we will not look at the past performance. Then as an investor who is not an expert, I want to make money. That's why I'm investing. So if I'll not look at performance, then what? What should I look at then?
So I think investors should, if they enter with optimism. I won't say they enter with hope that, okay, whatever I do, I'll still make money. I think people enter speculation with hope, but investment with optimism. And that's not wrong, having optimism. Optimism is not, again, about something specific. It is about it is more general, whereas hope is more specific. When you are taking an investment, suppose in a mutual fund or so, I think one should understand that there are two main inputs that go into investing. It is the investment process and the investment team. Investment houses don't control outcomes.
Okay.
They control inputs. So if you put the best of inputs, the outcome is likely to be good in the longer run.
So the investors, what are these inputs that an investor should look at to say, okay, this is a good fund house or this is a good fund, and the fund manager is doing the right thing. Therefore, this is a good fund that I should stick to. What are these 4-5 inputs that, from the investor point of view, they should look at?
You should look at quantitative as well as qualitative factors, and there are quite a few of them to look at. But let's say first and foremost is, like, you understand the investment philosophy and the process of that fund house and the fund that you are investing in. An investment philosophy is like a lighthouse to the investment process, that this is what we believe will achieve good returns over a longer period of time, or generate alpha or superior returns over a longer period of time.
For example, like, just, what is a good investment philosophy, or like, just for us to understand what is an investment philosophy with an example.
I'll give you an example of our own fund house. So in Bajaj Finserv AMC, we have an investment philosophy which is defined as an acronym called INCUBE.
Okay.
That if you want to do better than the crowd or achieve superior returns or beat the benchmark, you have to have some edge in investing. And there are three sources of edge: information edge, quantitative edge, and behavioral edge.
Okay.
So we use tools and ideas from these three edges and put it into a process for better returns. This is what we stand for, that this is what will make returns or superior returns over a longer term. This is the belief that we stand for. So investment philosophy is what an investment house believes will create wealth over a longer term. Many define it as what, and some define it as how. So we have gone for the how, that you can actually use information edge, quantitative edge, and behavioral edge to generate superior investments. Some go with what. So say an equity house may have an investment philosophy like, we will buy a good business with good management at a reasonable valuation, and that's what will generate returns. A fixed income house may say that first you should look at safety, then liquidity, and then returns, and that generates better performance over a longer term. So some define it as what we need to do, and some define it as how we need to do. We've chosen how because it gives us very specific ideas on our process design, on what we need to do, what kind of tools we need to use in that. An investment team is also equally important here. So as people say, investment is a combination of science and art. And the experience of the team, the kind of diverse views that a team brings in. I had written a small article on how to design an investment team. You need to have common values, but you need to have diverse skills. So common values of what creates wealth, but diverse skills of quantitative or qualitative assessments, or people with different experiences, so that as a whole, the team is able to learn and grow together. There are these two are the most important ingredients. As I said, we use a lot of behavioral tools. Everybody is a human, even in investment team, analysts, fund managers, they may have a certain bias. And what we do is we use certain behavioral tools to identify our own biases and understand where can we go wrong.
So, for example, this is advice that, in market fluctuate, you should not panic. Investor has only, say, few lakh rupees, but for a fund manager, there are crores of funds that are lying in the market. So, what do they do to not panic, and what are these tools that they said, okay, I know it, I don't have to panic. Can you
So there are many tools we use, and I can give you examples of some of them. When we are investing in a company, so generally people give one target price. So you would have seen on television or whenever some analyst reports or something come, people give one target price.
So for our audience, target price, if you can just explain.
Yeah, so target price is the fair value assessment of a security or a company.
So we are expecting that it will reach there.
So say currently the market traded price of a particular company or a stock is say 100 rupees. Through a certain valuation methodology, you come to a target price, say 125, just for example's sake, that this will go to 125. Typically target prices are for a year. They may be rolled forward, say for 2 years or so, next year, how much it will be. But typically the usage of target prices is more for a 1 year period, that this is 100 and this can go to 125. When we are looking at putting these target prices, we actually encourage analysts to give 3 target prices rather than 1. You're forecasting the future. The future may not exactly unfold as you expect. So why not also look at what can go wrong, say, and create a bear case scenario? While if the business goes into its normal trajectory, this is where you reach, this will the value it creates. But in that journey, something can go wrong, and that can be a bear case scenario that, worst case, this will happen. And what is the target price there then? Say for this particular security, which is at 100 rupees, the fair value is 125. But if things go wrong, if certain regulations change or certain trade tariffs come in and all, the target price would be 90. There can also be an optimistic case that, we are hoping or we are expecting that there is a positive thing that can happen in this business. The company may get a new order because it has built up new capabilities or so. And then the target price can be 140. Now, this gives you a bull-bear case scenario. We also encourage analysts to put a probability. Why do you think this can happen or no? Now, with this kind of scenario, first you know the risk return of a particular security, because now everything is defined. This is the risk, this is the return, this can be the bonus that you can get out of it. Bonus in terms of extra return that you can make. You also know why it can happen. The tariff can hit you or new business can take you up. We put certain pre-commitments on that then. In this journey of the stock price, suddenly a bad news comes, which we have taken into a bear case scenario, and you see the market has not reacted or completely. Many a times, market reacts to new information less than what it should. So that we typically call it under-reaction to a news. And that gives you an opportunity to get out from there, because you find the downside to be quite huge. So we use these to put certain pre-commitments whenever we are going. So here we are able to address analyst biases. We are able to understand risk return better, and fund managers are guided that this is the time I need to take profits, or this is the time I need to hit a stop loss. This is the fair value that I'm going for. Fund managers also, what we use a system called investment journal. We've taken that from how airplanes have a black box. So there's a beautiful book by Matthew Said called Black Box Thinking. Fund managers, when they take a trade, they write a few lines. There is a research report why we are taking that, but they write a few lines about why they are taking the trade on a particular day at that particular price. Like a black box collects the interactions between pilot and the co-pilot and what decisions are taken. So in case something goes wrong, they can analyze, they can retrieve the black box and see what went wrong. So this investment journal is like a black box where when we do the analysis of our funds, of our performance, we not only look at the numbers. Okay, this stock did well, very good. This stock did not do well. Why? What went wrong? We also analyze it along with why we had taken the position. Could we have avoided the loss? Is there a lesson to be learned in terms of that? This is what gets us good returns. Typically, this is what risks we face. And we use these learnings to put it into our investment checklist so that we don't repeat those mistakes. So this is where you try to help the team in uncovering biases, debiasing to some extent, and the learnings that we get from our mistakes or so, we put it into our checklist so that we don't repeat them.
So similar thing, what can investors do? So this is a good framework for you as a fund manager to select. Similar lines, what can investors do to say, okay, this we should look at this fund, I should not look at this fund. Is there anything you'd like to talk there?
So all the tools that we use in our investment decision making to control our behavior, and some we use to take advantage of the crowd behavior, can be used by investors. We have been writing, publishing, talking about these tools, and they are available on our website, on our channels that people can learn from. These are simple tools. They are not something that,
for example,
one would say that, like for example, just go and get a notebook and a pen, and whatever investment decisions you are taking, just write down why you're taking those decisions today. And at the end of the year, when you're evaluating how you've done, evaluate with why you had taken that position. If you don't write this, the mind is so beautiful, it will create reasons for you when you look at the end numbers. I was told this little joke by somebody that, you put a person who's a trader in the market in a room, don't let the person access the data or the markets for the day. At the end of the day, go and tell this person that, market was up 3% today. And why do you think that would have happened? And the person will give you reasons why, what positives could have happened. And then say, oops, sorry, I made a mistake. Actually, the market was down 3% today. And you will find the person with very good ease can tell you why the market would be down 3% today. So the mind actually looks at the outcome and with hindsight bias or something then says, oh, I would have taken it for this reason, or I would have thought about these things while making the investments. When you actually write it down, you will be able to analyze how you've done better. And a lot of people analyze their losers, and investment journal helps in analyzing them in the right way, whether it was luck or you made a mistake. Sometimes things just go wrong in what you invested in. Other important thing is, many people don't analyze the winners and never take any learnings from there. From the winners also, you should know whether it was luck or skill. And if you have found a pattern of investing or a way of investing which is better, then you should repeat that and repeat your success. Only when you build a process by your learnings and experience that you can repeat your success. Otherwise, how will you? So these are some tools that any investor can use. It's not that only a mutual fund should use.
So Nimesh, these are very good framework that professionals do. lot of people might not be able to do. Okay, so my question to you is that as a retail investor, because I will not be able to do all of this, I'm trusting a fund manager to do this for me, and therefore I am choosing a mutual fund. Okay, so should I really be bothered about all the macro news that comes? For example, there is a lot of talk about valuation of small caps and mid caps, or for example, there is a lot of talk on US tariff. Okay, I as a investor in a mutual fund, I'm not doing direct stocks. If I want to do mutual funds, why should I be worried about it? I'm expecting that fund manager will take care of it. Is this a correct way to think, or should I also be learning about it?
So when you are invested in, say, a fund like Flexi Cap, which can move across themes, across market caps, across sectors, then the investor doesn't worry. It's a fund manager who will change the allocations accordingly. Some investors choose to themselves allocate a certain portion to a small cap or a mid cap or a certain theme or a sectoral fund and all that. Now, maybe with advice or on their own. So then the decision lies on updating these things with the investor. There are certain investors who decide on their asset allocation themselves, like how much to put in gold, how much to put in fixed income, how much to put in equities. Some investors may just choose to invest in a multi-asset allocation fund, where the fund manager changes based on the opportunity he or she is seeing. So it is what suits your investment profile or your investment goals that you should choose these funds. Some people want to be actively involved in tracking, and they can actually go through fund manager commentaries. We publish every month, at least in fact sheets. There are a lot of other ways of which we communicate through media, through our website, through our publications, of what we are thinking and why we are designing the portfolios in the way they are. Some investors actually use that to understand, evaluate whether they're how their money is being managed. Again, I'll come back to the two major ingredients. Like, you should understand the process, the investment philosophy and the process of the fund. And you should understand the investment team and how they are working. If you want to be involved more in terms of your asset allocation, then you choose the funds yourself. Otherwise, there are many diversified funds available for the investor, where you can leave it to the fund manager to take the call in terms of flexi caps or multi-asset.
So would it be fair to say that there are certain funds designed where you can just rely on a fund manager, like diversified fund, multi-asset funds, and flexi cap funds, where you can say, okay, I can rely on fund manager, while if I choose slightly more focused funds or a particular theme funds, for example sectoral funds, small cap, mid cap, I should also be knowing and understanding where these funds are getting invested. Is this correct way to think?
Yeah, so you either leave it to the fund manager, or you have an advisor, or you do it yourself. And everything then requires that kind of effort then. If you're leaving it complete to the fund manager, it's the fund manager experts who are doing it. There are experts in financial advisory or distribution who are helping investors do this, or you do it yourself. So these are the three ways one can do this. If you're too close to the money, you have to also be conscious that you need to have a process that helps you de-bias and reduce your emotional reaction to the market. As you go a little away, so if you are using an advisor, you are slightly away from reacting emotionally to your money, and through them to the fund manager. So again, you are a little bit distant from taking your own decisions, so that emotions are automatically controlled a little bit, or somebody is helping you control those emotions. Otherwise, when you're doing yourself, you should have a good investment process and you have to stick to that process with discipline. Otherwise, uh, history has shown that an average investor moves like a pendulum between greed and fear. There are other biases also that impact, and that can lead to substandard returns.
So, uh, before you started, you mentioned that there is so much news in social media and everything, right? So, unless I understand all of this, it's better that I don't unless I understand what is the impact of US tariff, understand unless I understand whether what people are talking about valuations. Uh, if I don't, then it's better just to be away from it, right? Otherwise, I will just be either be afraid of what is happening in the market. And like yesterday I was talking to somebody, and they said that market fluctuation is not a bug, it's a feature. Okay, so if that's the case, then I should rather be away from it, unless I say no, I will understand how valuation works.
So it's a choice that there's nothing wrong in doing it yourself or so, but you should know the challenges on each side when you're doing it. See, a lot of people feel confident when they collect more information that I know and I have collected more information. Uh, there have been studies, and especially a very interesting study by psychologist Paul Schlovick. What he found was that beyond a certain point, gathering more information doesn't improve the accuracy, but it increases the confidence. So, if when you're investing, your accuracy is less, but your confidence is more, or you're overconfident, then the outcome can be quite negative. The other thing I have noticed is because of this bombardment of information, people react to the strength of the signal rather than the weight of the signal. Let's say we want to check a coin, you're tossing a coin and you want to check whether it is biased towards heads. You toss the coin 10 times and 8 times the coin came on heads. Here, the strength of the signal is very high, that 8 times out of 10, 80% of the time you got heads. But now, suppose the same coin you toss 1,000 times and you get 650 times you get heads. The strength is low because now you got 65% of the time. But the weightage of this signal is high because you have taken a large number of outcomes and then calculated this. So when something is uh, told you in a the statements in the news or media are framed in a certain way, people may react to the strength or the noise of that signal rather than the actual weight of that signal. So, for example, when tariffs are announced or so, a lot of people get worried the way it is thrown at you.
No, I'm worried because, or rather, my question is that, even now we are living in the meme world, right? So even people who don't understand anything about tariff, they're making meme of Donald Trump and sending you and creating this. I mean, you have made a meme, but do you know what exactly is happening, right? So I'm inclined to believe that it's better to stay away, if unless you're an expert, and let the fund managers and advisors take a call.
So clearly, this is what the job of professionals who are doing fund management and investment is, and this is something that investors benefit from when they are part of a mutual fund scheme or so. Yeah, I agree.
Okay, so another thing, right? So uh, people who are starting can look at it differently, but people who are, say, in 40s and who have been investing for a while, they have certain products, they have certain asset allocation, whether designed or by default. uh, New NFOs keep coming, new IPOs keep coming. I want you to answer it more like an investor than as a fund manager. How should I look at it? Every time there is a new NFO, every time there is an IPO, should I be really concerned about it, or I should look at my own portfolio and see whether I need something? How would you approach as an investor when there is a new product in the market?
So it's a new option that has come to you,
Hmm.
right? Your choices have increased.
Hmm.
Every time a new company is coming for listing,
Hmm.
it's a increase in the choice of investments that one is having. And if I find that this has potential and coming at a time or the valuation or the style which I can benefit from, then one should go for it. Obviously, there will be comparable companies or comparable. Nothing is exactly the same as what is being given, but there will be comparable opportunities. So one should evaluate on their own whether something new comes in as a good fitment to my portfolio, or I already have something which takes care of it. Uh, Index funds are slightly different. Index funds, for example, if somebody is launching an index fund and another company is also launching index fund, there's very less differentiation there. But if you look at active funds, you will find different styles, different themes, different processes being introduced in the market. And you pick up what suits you in terms of your risk profile and what portfolio you want to create or what asset allocation you want to create. The industry, as it evolves, it will offer many specialized products, many choices to the investors. Now, say, even if you see with mutual funds now, you have another new asset class like a special investment fund coming in. There are obviously PMSs, AIFs also there. So the bouquet of choices for the investors is increasing. And thereby, people will be able to better select what suits them or what they are looking for.
So then, what is the right diversification for somebody? What does it mean to have diversification? Because I can't be too diversified, or should not have. Like typically, if you listen to advisors and people, they say 4, 5 funds, 6 funds are enough for you, right? And if I already have, how do I
So
evaluate
I
that?
would give this is more of a personal opinion. See, true diversification is actually, sorry, I'm maybe using a little technical term here, but uh, it should be less correlated with what I have. If I am buying or investing in something new, but it is exactly it's moving exactly the same as what I have already in the portfolio, then it is not true diversification. Then I have not benefited from this new addition. So true diversification actually is a bit uncorrelated.
Uh, just explain what is the philosophy of diversification in simple terms, so that we can relate it to better.
So um, let's say you are invested in a fund which is on a growth style of investing, and say you have invested in the mega trends fund, and you that is following a growth style of investing. There is another fund which is based on quality style, which is based on, say, moat investing. Now, while you have a growth style fund, you introduced a moat investing kind of a quality style of fund that gives you benefit of diversification. Both will not move exactly together. Both may benefit, but it's not that both will fall together or rise together. That gives you diversification. So there's something at some point of time protecting value, something at some point of time is accelerating your returns. So these having these different styles gives you true diversification. Uh, you should not, as people say, you should not have all your eggs in the same basket. So you diversify to reduce your risk. And if everything that you investment is highly correlated to each other, then that risk mitigation doesn't come in.
So how do we understand whether the funds are same or different? What should investors look at to understand that like for example, there is one flexi cap fund that somebody is interested in, and let's say there is another flexi cap fund that is doing well. Now, obviously, I should not look at it because of purely from the performance point of view. But if I want to evaluate that, how should I know that this flexi cap fund is different from this flexi cap fund? What are those things that will help me understand that these are two different funds?
So there are many tools that give you a uh, analysis of how two funds are different. One of the things you should look at is how the fund is different from its own benchmark.
Okay.
There, so many flexi cap funds would have one benchmark. Many large cap funds would have one benchmark. One of the things that we share with people is how much active share we have. How much different are we from the benchmark? Uh, that shows how different the fund's portfolio construction is, shows how different the selection is of a particular portfolio compared to what they get in a benchmark, how different the allocation is compared to the benchmark. So active share is important to look at. Another thing, what you can look at is certain risk ratios, like for example, the beta of the fund, standard deviation, uh, value at risk. So depending on how much analysis you want to go deeper into, but let's say volatility and beta gives you a fair idea about how different the fund is from the benchmark. Then those can be then compared between different, say, scheme A, scheme B, scheme C, scheme D. What are the different parameters that they're going to? I would also say you can, if somebody can, they can do a style analysis or a factor analysis
Where
of
do
the
you get the
funds.
information on the style and
So the good thing is now a lot of service providers, websites, publishers are giving these data. Um, I think much of it is actually freely available. It just requires a little bit of time and effort to
so
study
style of
them.
the fund meaning investment philosophy, or what is the style of a
So
fund?
you typically people classify that a growth style, value style, quality style of fund, and that reflects in some number or the other. Typically, quality may be a little less volatile. Say valuation of the fund will tell you whether it's a value styled fund or no. It's a the valuation of the fund may be lower than the benchmark valuation. Whether you look at price to book, price to earning, those ratios. I would say it again that it requires a little time and effort to study them. Um, Information is available, and many of these I think whether it's advisors or certain data providers, they can give you a certain report card of a fund, like how what kind of style of investment the fund follows. I think those can be used to differentiate and understand what you are investing in, and I think it is very important that before you make the investment, you understand the fund's uh, style, factors, valuation.
And
Those
it
are
is very
important.
much possible that if even if the fund is from the same category, it is different because of the style, because of the benchmark it follows. Is that correct understanding?
Yes, yes. So active share will tell you how different it is from the benchmark. The other ratios will tell you what style they are following. I would insist that you look at it before you make an investment, because after you make an investment, then there is something called an endowment bias or something comes in, where again you start feeling, okay, what I have done is the right thing. And uh, then you only look for positives and confirmation bias and all that.
So Nimesh, as a fund manager, okay, uh, what can you tell investors uh, for you to trust uh, you completely, saying okay, we are doing our jobs and you should study, obviously you should read the fact sheet, you should study your end, but they can trust you because what is being proposed is that long term investing is there. So I people are putting their hard earned money for 10 years, 15 years, and they should not be worried about this market news and social media noise and all the news that they don't understand also, and trust you. What is it that you can tell them?
I think the mutual fund industry is a very transparent industry, and it is extremely well regulated. So I think that should give the trust that among investors that whatever we are doing in terms of our function on a day-to-day basis, creating portfolios, everything is very transparently available, communicated, and very clearly stated. In fact, if you see our fact sheets and our communication, there is a lot of information available there for some keen investor to really study what we are doing. They have everything available to take their decision, and this very well regulated industry, which is in whether it is in terms of fees, whether it is in terms of communication, whether in terms of construction of portfolios, whether the way we are working. I think that should instill some faith and trust. You see returns that mutual funds have generated, both in fixed income and equities, over a longer period of time. They helped, mutual funds have helped investors create wealth, reach their goals. Um, and This is a young industry, this is an evolving industry. We'll see so many different ideas, products coming in, will give a lot of choice. Already there's good choice. We'll give more choice to the investors in terms of picking what suits their risk profile, what suits their asset allocation, what suits their financial goals. So I think that is what one should be confident about, that the money is managed well. It's a well regulated and transparent industry. And look at the track record of funds. They've created wealth and they have helped manage risk, manage returns, and helped investors in their investment and financial journey.
Okay, I'll stick to long term. So again, if I'm investing for 15, 20 years, and I'm talking about not stocks, mutual funds only, uh, I should just stay invested, or I should also book profits between the cycles, right? 20 year is a long time. So one approach is I start putting now, and I do not just take it out for 20 years, or there we should. And I'm asking you this because again I was hearing some fund managers is saying, booking profit at certain times is also a good way to deal with your investments. So
So time in the market is more important than timing the market, is what's said. The same people have also said that it is better to be greedy when others are fearful and fearful when others are greedy.
mm,
The idea is that if you are trying to time on a short term basis, then you may lose out on the returns. On a longer term basis, there are times when there's a lot of fear in the market, there's panic. And at that time, many good investments are available for some short term reason. They are available at a good valuation. So one should actually increase investments there. Exiting or reducing your investments can be based on whether a financial goal was realized and whether a particular target need that was being the fund was being used for has come about and you actually move money there. Otherwise, I think the longer the investment, the better. That can be a general rule. Otherwise, it can be specific marks that one looks at.
hmm. So we did a campaign together only, and we picked up the cue from your speech only, where you said investing is like getting married, and we did a full campaign on that. Could you elaborate? What did you mean by that?
I'm
And
glad you remember that. So, idea was to tell people that this is a long-term commitment, like a marriage, and there are some similarities. At that time, I remember I had written a little bit of note there on what are the similarities. I'm not trying to say it is exactly the same, but I had used the analogy of marrying somebody and making a long-term commitment, saying that if you are investing just on returns, so you sort all the investments based on returns and invest in the top, that's like getting married by just the looks of the person, right? That it looks the person looks good and you're getting married. So uh, then I had put what are the ways to evaluate a fund, and which is like, looking at whether this Jeevan Sathi you have will be with you in good times and bad. So where, like, you assess funds returns alongside the risks also that are there. And I had l- highlighted certain other qualities, saying that, like, you just don't go for the looks, you go for other qualities also. There I had put across certain ideas on how to evaluate a investment philosophy, a process, the investment team, the strategy of the company, what are the parameters and the portfolio risks to check on that. So yeah, in a way, it is giving a perspective to people that don't just do a very superficial analysis.
That's the crux of
Yeah,
it, that you don't do a very superficial analysis. Just don't look at the performance and say, okay, I will invest, or people are talking, this fund is good, you invest. You do
yeah,
a proper thorough evaluation.
yeah.
Okay. uh, Last question, Nimesh. So what should be the guiding principle for investing? Okay, or before you answer that, what is investing in very simple terms, and therefore what should be the guiding principle for people, investors, uh, staying put?
Investment is a very exciting journey where you have certain goals in mind, certain needs, certain wants to be fulfilled, certain desires to be fulfilled, and you are planning and investing for that. uh, you're working hard for your money, you're saving the money, and in the longer term there are certain goals that you want to realize, have a certain lifestyle, a certain retirement, maybe children's marriage, education, so on. And you, for those goals, you are investing. uh, Most of the people, they start right, in terms of they start early, they start on the long term journey for investment. But in between, because it is a very emotional, very uh, high noise kind of a activity. See, when you're investing in real estate, for example, it's easy to have a long term view because uh, nobody's talking about prices every day for your house, right? If some bunch of people gathered near your window and every day started telling you prices, that today the price was this during the noon, this was during the evening, all that, even real estate investment will become difficult. Uh, so if you can cut through the noise, stick to your path of investment journey, stick to your asset allocation, stick to your discipline, then you will reach those goals. In between, temperament is more important. Knowledge is important, but temperament is more important. How you react to the information that is given to you becomes very important. Uh, there are certain simple tools which one can use on this investment journey to realize those goals. But I would say thinking long term and being patient, I think those are the two most important. And that is something that the person has to do himself or herself.
Okay, thank you, Nimesh. Thank you very much for your
Pleasure
time.
being here, Bhartendra.